Good afternoon, everyone. Thank you for joining. I'm going to go ahead and give it another minute or so before we go ahead and get started. Good afternoon again, everyone. Thank you for joining. If anyone is on, if you could put just a hello or something in the chat or questions box, just so we make sure the audio is working, that would be great. Okay, perfect. I'm seeing a bunch of thumbs up, so great. Thank you again for joining today. Today we are going to be talking about SBA's recent final rule that was issued largely on the HUBZone program, but there's a bunch of other stuff in there. So we'll go ahead and dive right on in. Just quickly, my name is Meghan Leemon. I am a partner with PilieroMazza in our government contracts practice. I specialize primarily in anything small business related, all of the socioeconomic programs, as well as mentor-protégés, joint ventures, and assisting compliance with just general government contracting compliance, and as well as impacts of acquisitions and things of that nature. A little bit about our firm. PilieroMazza is a full-service business law firm. We are based in Washington, D.C., but do have offices in Maryland and Colorado. Our primary practice area is government contracting, but as you can see, we have a lot of other services to provide. And our other core practice groups include construction, labor and employment, litigation, and business and transactions, in addition to government contracts. So thank you again for joining today, and we'll go ahead and move on to the next slide. Today, we are going to be talking about a number of the changes that SBA has included in the final rule. These will impact the various socioeconomic programs, including 8A, WSB, SWSB, HUBZone. And then we're also going to talk about negative control and what that means. That's applied to all small businesses. A minor adjustment to the calculations of receipts. Some changes to the ostensible subcontractor rule, and I'll explain what that is as we get there. Some mentor-protégé and joint venture considerations. There's not a ton in this particular rule. There should be more coming in a future rule, but we'll touch on some of the high points here. Then lastly, I will talk about the recertification of size and small business program status, depending on certain triggering events. This webinar is not going to address every single change that SBA has proposed or has finalized. The rule itself is extremely lengthy. I think it's over 200 pages or so. So if there's a specific question or concern, feel free to reach out separately and I'll try to get an answer to you. But today I'm going to touch on the high points and some of the kind of overarching and bigger changes that SBA has made. As we go, if you have questions, I will try to answer them in real time. Otherwise, I will see if there's enough time at the end to get them. Otherwise, I can try to address them through email. If you want to submit it and I don't get to it, I will try to get back to you later this week. So just a little bit of background. SBA issued the particular proposed rule that I'm going to be talking about that has now been finalized on August 23rd, 2024. It's entitled HUBZone Program Updates and Clarifications to Other Small Business Programs. So while the title of the HUBZone program or the title of the rule directly relates to the HUBZone program, there's obviously a lot of other things that were in this rule and have other implications much more far-reaching than the HUBZone program. SBA had a 45-day comment period. Comments were due on October 7th. According to the final rule, the SBA received over 650 comments from 261 commenters. The final rule, and this is the regulatory site for the rule, is 89 Federal Register 102448. It was issued on December 17th and you're supposed to provide at least 30 days notice before a final rule goes into effect. So the effective date for most of these changes that I'm going to discuss is just in about 10 days or so, January 16th, 2025. There is an exception for the size and recertification regulations where there is a delayed effective date until January 17th of 2026. And I will discuss that more when I get there. SBA confirmed that this rule has no retroactive effect. However, SBA did note in the final rule that once the rule is in effect, so January 16th, the rule changes will apply to existing contracts. So you sometimes would only apply it to future solicitations or future contracts, but they have clarified that this will impact contracts that you currently have in addition to future pursuits. The first kind of topic of changes that I'm going to discuss is changes to the 8A program. SBA has increased the allowable ownership percentages for certain non-disadvantaged individuals and business concerns. So as you may or may not be aware, under the current rule, a non-disadvantaged individual, so not a qualifying owner or a non-participant concern, so basically just an entity that has at least a 10% ownership interest in one company that's currently a participant in the 8A program, can not own more than 10% of another participant in the developmental stage or 20% in the transitional stage. And if you don't know, the 8A program is a 9-year program. The first 4 years are the developmental stage and the last 5 years are the transitional stage. But just take, for example, if you own 49% of one company that's in the 8A program, and then you want to take ownership in another company, because you already own 49% in one, this rule limits the percentage that you may own in another. Those percentages are now, with the final rule, going to be increased to 20% in the developmental stage and 30% in the transitional stage. And again, this particular current rule applies where one person or a company already has ownership of any amount, 49% or less, in another participant. So these percentages are going up. A similar rule exists where there is a company that owns, or a person, of a company that is in the same or similar line of business of the 8A participant. And same or similar line of business is determined by looking at the primary NAICS code of each company and looking at the first 4 digits. If those overlap, then the companies are in the same or similar line of business. So either a company or a principal of a company cannot own more than a 10% interest in the developmental stage or 20 in the transitional. Similar to the prior rule I just discussed, these percentages will also be increased to 20% and 30% respectively. This change does not, however, impact the ability for SBA approved mentors, which presumably are in the same or similar line of business. And they can still acquire up to a 40% interest in a protege, including an 8A participant, through that mentor-protégé agreement. Some other changes to the 8A program include around when or when not prior approval is necessary for change of ownership of an 8A participant. Generally speaking, many changes of ownership to an 8A participant require prior SBA approval. So you cannot go forward with the change until you get SBA's sign off. There are currently certain exceptions in the rule for this, and with the proposed rule and now the final rule, SBA has added or expanded a couple of those exceptions. So right now, you do not need prior approval for a change if the non-disadvantaged individual, collectively with any family members, owns 20% or less before and after the transaction. Now it will be, or effective January 16th, will be that non-disadvantaged individuals own 30% or less either before or after the transaction, does not require prior SBA approval. There's also no prior approval with the transfer results from death or incapacity. Makes sense because that's not entirely something you can predict. There is no requirement for prior approval if the disadvantaged individual or entity who is the qualifying owner will increase their percentage of ownership. And this new one is if the participant has never received an 8A contract and the individuals or entity upon whom eligibility was based continues to own more than 50%. So if a company is newly in the 8A program or just hasn't really been successful, unfortunately, in receiving 8A work, if there is no 8A contract and there's no change to the qualifying owners for eligibility, then you can proceed with the change without getting prior approval. Again, if you do any of these without prior approval because it's not necessary, you still have to provide notice to SBA within 60 days of the change, or, and this was recently added, before submitting an offer on 8A contract, whichever occurs first. So you still have to provide notice. And in the 8A program, I will note the 60-day notice requirement is longer than changes of ownership for certain other socioeconomic programs, which generally is 30 days. So you need to be mindful if you hold multiple certifications, you want to make sure you're complying with the earliest notification date. Another change to the 8A program is that SBA has eliminated the requirement to consider state community property laws in determining ownership interests. So if you live in a community property state and you're in the 8A program, you may recall that SBA required a transmutation agreement, basically transmuting the spouse's ownership or rights to ownership in the company to the individual property of the qualifying owner. That is no longer going to be required for applicants. Another change to the program, and this is applied kind of across the board, but is now going to permit a minority owner to have a right of first refusal to purchase the ownership interest of the disadvantaged individual without affecting the unconditional nature of the ownership. So one of the requirements for the 8A program is unconditional ownership. And if the qualifying owner wanted to sell if there was a requirement to first make that sale to the minority owner in the business, SBA previously viewed that as a condition on the ownership of the qualifying owner. That is no longer going to be the case starting on the 16th. Other changes that I wanted to mention for 8A program participants is regarding the business activity target. So every company that's in the 8A program in the transitional stage has to hit, or should hit, or at least aim to hit, a certain level of non-8A revenue. So a certain percentage of the revenue that the 8A company receives should be received from non-8A contracts. That percentage, increases every year in the transitional stage, with the idea that the company does not become dependent on 8A work, such that when it graduates from the program, it's able to compete outside of the 8A program. In terms of what this means if you don't hit the targets, SBA's regulations used to be pretty severe in that the company would be placed on a sole source restriction. So the company would no longer be able to be eligible for award of an 8A sole source contract until either they came back into compliance or other certain extenuating circumstances. A couple of years ago, SBA's regulations were revised to provide that the sole source restriction will not be placed, or will be placed only if a participant is not making good faith efforts to obtain non-8A work. And if you were to demonstrate your good faith efforts, generally speaking, a company would provide SBA with copies of proposals demonstrating bid amounts and all of the contracts that they bid on that were non-8A contracts, that had they been awarded those contracts, they would have been in compliance with their non-8A revenue percentage. SBA in the proposed rule and now the final rule has tried to provide more guidance in terms of what they will or will not consider. So as I mentioned, you would provide evidence to SBA of particular contracts that you bid and the amount of those bids on non-8A contracts. Now SBA is clarifying or confirming that we'll only consider the base year value of that contract, not the full projected value of the contract, in determining the amount that they would add to your revenue, like had you been awarded that work. And SBA will not consider projected revenue under a particular contract where SBA determined that the participant submitted its offer without a reasonable prospect of success. So essentially, if you're just submitting bids that you cannot win or have no chance of winning on small business set-asides or some other type of set-aside, or whatever the case may be, SBA is going to want to look at and somehow make a determination that they thought you could reasonably have a chance of winning that contract. And only in that event will then you get to claim the base year value of the contract. So this is placing a pretty significant burden on 8A companies to really monitor and track the non-8A or their 8A versus non-8A revenue, and then also what efforts are being made to obtain non-8A work. So if you're in the 8A program and you're not hitting your targets or you're close, you definitely want to be mindful of this. Another change that I just want to mention briefly is SBA is changing the thresholds for what types of financial statements participants have to provide. Depending on the level of annual revenue, SBA requires different levels of financial statements, whether that be in-house, reviewed, or audited. SBA recognizes, especially for reviewed and audited, that these take time and cost small businesses quite a bit of money to prepare. So SBA is increasing the thresholds. So if you're under $7.5 million in revenue, you can still provide in-house. If you're between $7.5 million and $20 million, you're required to provide reviewed financial statements. And if you're more than 20 million, you are required to provide audited. This is an increase from the current 10 million for audited. So hopefully this allows companies to not spend the money if they don't have to for longer. Something else that SBA has added to the regulations is regarding substitution of an 8A contractor, because generally speaking, the company that is awarded an 8A contract needs to continue to perform that 8A contract, or it could be terminated. SBA is adding a substitution possibility for 8A joint ventures if the joint venture is looking to have the contract novated to the 8A participant. So each member would still have to agree to the novation. The non-lead partner will need to transfer the assets to the 8A lead, and SBA will still have to determine that the 8A participant continues to meet all 8A eligibility requirements. But this could potentially help if you're part of an 8A JV and you're looking as the 8A partner to maybe take over the contract on your own. So just quickly, some other changes that are kind of applying across the board to 8A WSB and SDWSB programs, and that includes EDWSB and BOSB. I just went with the most common acronyms and programs used. But SBA was trying to finally harmonize the provisions to align across all of the programs for ownership and control. If you read the 8A versus WSB versus SDWSB ownership and control regulations, you would note that there were some nuances and some differences in the regulations, and that those nuances could lead to a different interpretation or different requirement. And that was not SBA's intent, but that's how it's been operating. So essentially, SBA is just making all of the programs have the same ownership and control requirements. For example, there's a requirement currently in the 8A and SWSB regulations that the qualifying owner be the highest compensated. There isn't a similar requirement in the WSB program. There will be effective January 16th, but there wasn't currently. Another change that SBA proposed is that if you change the compensation such that the qualifying owner is no longer going to be the highest compensated, you now have to provide notice to SBA within 30 days of that change. For 8A, currently, you previously had to get prior SBA approval to make that change, but that is no longer going to be the case. It's going to be the same across the board, 30 days notice requirement. SBA, as I mentioned already in the 8A realm, is going to permit a right of first refusal for the non-qualifying owners. This is already in the SDWSB regulations and now will be in 8A and WSB. There's also currently restrictions on fees for representatives of applicants and participants in the socioeconomic programs, or currently in the 8A program. SBA is now proposing to, or has proposed and finalized the application of this to all socioeconomic programs, including HUBZone. So for fees related to helping an applicant, someone applying for the program, they just must be reasonable in light of services performed. But if you're also looking to gain assistance with receiving a contract, that fee that you pay or a company receives cannot be a fee that's a percentage of the gross value of the contract. So you just want to keep that in mind, maybe as you're working with business development specialists or things along those lines, that you're being very mindful of this rule, as this will now apply to all socioeconomic programs. Next, I'm going to talk about some of the major changes to the HUBZone program. So for the HUBZone program, SBA proposed amending the definition of principal office to make several changes and clarifications. SBA proposed to require firms to provide a lease that begins at least 30 days prior to the date of SBA's review and ends at least 60 days after. This has been adopted in the final rule. This is something that's new. There was not currently a temporal requirement, so you just want to be mindful of the time for the leasing. If you have SBA could require you to provide evidence that you do business at that location or go through a live or virtual walkthrough. And if you have a shared space, you have to provide evidence that the firm that you have dedicated office space. There's, dedicated desks, chairs, computers, things of that nature. A virtual office does not qualify as a principal office. SBA had proposed that if you had a company that has 100% telework, then they could potentially be HUBZone if 51% of their employees resided and worked from a HUBZone. That did not get adopted in the final rule, so you still have to have a principal office in a HUBZone, and at least 35% need to reside in a HUBZone. And just as a refresher, a principal office is the location where the greatest number of employees at any one location perform work. So if you had a situation where everyone lives and works virtually and no one works at the same office or same place, then you could have a situation where you actually don't have a principal office for HUBZone purposes. So you just need to be mindful of that you actually are, having people go into an office. And depending on what other locations you have, be mindful of how many people need to be in that office. The next change I'm going to discuss is changes to the definition of employee. SBA explains that they propose to amend the definition to quote, prevent abuse and strengthen the integrity of the program. As you may recall, SBA proposed to increase the number of hours that are required for an employee to be considered an employee for HUBZone purposes from 40 hours a month to 80 hours per month. SBA received pretty significant pushback on this. So in the final rule, SBA has maintained the 40-hour threshold. However, rather than aggregating the 40 hours of work, looking at the 4-week period immediately prior to the relevant date, SBA is now including that an individual has to work at least 10 hours per week during the 4-week period. So SBA didn't want a case where a person would work, let's just say 40 hours a week, or 40 hours 1 week, and then not work again for the company for 3 weeks or whatever the case may be and still qualify. They want to see meaningful, continuous employment. There are minor exceptions potentially to this if you can demonstrate a legitimate business reason, such as like seasonal work, where the hours may fluctuate to less than 10 hours during certain weeks. But now it's pretty much a 10-hour a week minimum requirement. SBA also proposed to clarify, and they've already been doing this already if you're in the HUBZone program or have gone through any sort of application or re-verification or any of that, they want to see documentation that the individual is performing substantive work. Now it's going to be fully adopted into their regulations. SBA would ask for things like job descriptions, resumes, timesheets, work product, evidence of training, things of that nature. SBA proposed to remove the provision that individuals who receive in-kind compensation can be considered employees, and that was adopted in final. SBA also proposed that to clarify individuals who are obtained from a concern, quote, primarily engaged in leasing employees will be considered employees. So the primarily engaged language is new. It used to just say obtain, leased employees are generally considered. Now they want to see that the company that you're obtaining these employees from, that is they're primarily engaged in providing employees. SBA also apologies for that slight technical difficulty, but I think I'm back. The last point on this is reservists and National Guard members will still be treated as employees during periods of active duty, even if they're not receiving compensation from the HUBZone company. Another change is regarding legacy employees. So essentially, An employee that you had that lived in a HUBZone, qualified you for as a HUBZone employee, but then later either moved to a non-HUBZone location or their address is just no longer located in a HUBZone. SBA proposed to limit a company to one legacy employee at a given time. Again, SBA received a lot of pushback on this too. So in the final rule, SBA has clarified that a HUBZone can have up to 4 legacy employees, but must have at least one other HUBZone employee in order for any employee to count as a legacy. So you wouldn't be able to qualify as a HUBZone if you're relying solely on legacy HUBZone employees. At the relevant date, you still have to have at least one current HUBZone employee. SBA has also clarified, and this is important. So this was already, yes, this first part was already SBA's practice. An individual who qualified as a HUBZone resident employee by residing in a redesignated area or a qualified disaster area cannot and does not qualify as a legacy employee. SBA has also now added in this final rule that individuals who worked fewer than 30 hours a week at any time during their employment cannot qualify as a legacy HUBZone employee. So essentially, you are kind of looking at more or less full-time employees only being able to count as a legacy employee. So if you have someone working those 10 hours a week, still is on your payroll, and then later moves out of the HUBZone or their address is no longer located in a HUBZone, you would not be able to rely on that person as a legacy HUBZone employee because they worked less than 30 hours a week. So while SBA didn't propose a limit of, or why SBA didn't adopt their proposal of one legacy employee, their quote like compromise was this 30-hour minimum requirement for legacy employees. So that is a pretty significant change, and one that you should definitely be mindful of. Other changes that SBA has proposed is to the definition of what it means to reside somewhere. This one actually was a welcome change. SBA proposed to change the requirement for an individual to have lived at a location for 180 calendar days prior to the relevant date to 90 days. That's been adopted in the final. So rather than having to demonstrate residency for 180 days, it's now less, it's half, it's 90 days. So that should hopefully make compliance with the residency requirement a little bit easier. SBA will still rely on driver's license to demonstrate residency, but SBA will still continue to accept other forms, other proof like deeds, leases, or utility bills, or an explanation why an individual does not have a driver's license or why the driver's license is inconsistent with where they actually live. One of the other changes was, what does attempt to maintain mean? If you're in the HUBZone program, you're probably aware that the rules currently state that attempt to maintain is associated with a 20% residency threshold as opposed to 35%, and applies if the company has been awarded a HUBZone contract. SBA has clarified that the 20% floor is not an automatic substitute for the 35%, and companies at all times should still be trying to achieve the 35% requirement. At the time of a recertification, a firm that is performing on a HUBZone contract and falls below the 35% can still recertify as long as at least 20% of the employees reside in a HUBZone and the company is making substantive and documented efforts to meet the HUBZone residency requirement. So you still, if you're at, you can't take the position that I'm at 20, I'm good because I have a HUBZone contract. You still need to be making substantive and documented efforts to get to that 35%. SBA is also kind of putting a cap on this 20%. So, and a time limit. SBA doesn't want a company who gets awarded a HUBZone contract to just kind of forget about it and try to stay at 20 instead of 35. So if a certified HUBZone has been awarded a HUBZone contract within 12 months prior to the due date for the triannual, which they're changing now from annual to triannual recertification, then you can still attempt to maintain compliance with 35%. But at the next recertification, you're going to have to be at 35%, regardless of whether you have a HUBZone contract or not. I did get one question. Documentation for performing work applies to part-time employees only, correct? Yes, generally speaking, SBA only asks for evidence of work if the employee is under 30 hours or is part-time, but I wouldn't necessarily bank on that. And if they asked for someone that's full-time, you would need to provide that information. Some other changes, big changes to the HUBZone program is the date to determine eligibility. So once upon a time, as you may recall, for HUBZone, you had to not only be a certified HUBZone, but you had to be HUBZone eligible as of the date of offer and award, which was incredibly difficult because as government contractors, you are never going to know when a contract is going to be awarded. SBA changed that a few years ago so that you only have one date basically every year that you have to continue to qualify. It's your certification or your anniversary date. SBA is now kind of going back to a middle of the two. So now HUBZones have to not only be certified HUBZone, but they also have to be HUBZone eligible as of the date of initial offer for a HUBZone contract. So you need to be mindful when you're going to submit a bid, if you're complying with the principal office requirement and the residency requirement as of the date of offer. You should not be bidding if you are do not comply. So long as you're eligible for the date of offer, you should be eligible for award. But for sole source contracts, you do need to still be certified and eligible at the time of award. So this is a big change. You need to be mindful of your eligibility if you're looking at bidding on a HUBZone contract, because you don't just have one date to contend with. You need to be eligible as of the date you submit your offer. Okay, next topic is going to be on what is negative control. So under the current regulation, and this is 13 CFR 121-103 is SBA's kind of general affiliation regulation that applies generally to small businesses. Under this particular regulation as it currently exists, it explains control can be affirmative or negative. And negative control includes instances where a minority shareholder or owner has the ability to block an action by the board of directors or shareholders or to prevent a quorum. What this means and what is permissible or may not be permissible has kind of been developed over a number of years through SBA's Office of Hearings and Appeals, or OHA, and case law. OHA has explained that negative control exists when a minority owner can block actions essential to operating the company, but giving minority owners an ability to block certain extraordinary actions is not negative control if those provisions are crafted to protect the investment and do not impede the ability to, conduct the business of the company. So it's not there's not a set rule or a set list of what is okay, what's not okay. It's really dependent on kind of the case law. As I said, this general affiliation concept applies generally to small businesses, but if you are a participant in any of the socioeconomic programs, including 8A, WSB, or SCBSB, then there's a different set of rules and standards that applies. Under the 8A and WSB regulations as they currently exist, it essentially says all, and basically all means all is kind of how SBA has interpreted it. So the qualifying owner for an 8A or a WSB under the current rules, has to control every single decision of the company. That can be a really hard pill to swallow if you have a minority owner or investor that wants to be able to protect their investment, but can't because the regulations provide that the qualifying owner has to control every single decision. In SWSB a few years ago, maybe more at this point, SBA included a carve out for only 5 permissible extraordinary circumstances. And so those 5 permissible extraordinary circumstances were kind of carried over and proposed in the proposed rule. So the current list in SWSB is the first 5. And this is what SBA has proposed with the addition of the last one. So under the SWSB regs, unanimous consent or negative control can be required for adding a new stakeholder, dissolving the company, selling the company or all of its assets, merging, and bankruptcy. And then SBA proposed to add a 6th one of amending the documents to remove 1 through 5. In response to the comments, SBA, that list of 6 is very, very limited and would significantly impact companies that are merely small businesses, but maybe don't have another socioeconomic designation. One of the comments submitted was that there should be kind of a catch-all to allow for certain circumstances that are not specifically identified. Basically, the list should not be exhaustive. SBA agreed in the final rule that if the provision is crafted to protect the investment and does not impede on the company's operations, then it should be permitted. This is a big thing to understand. The same definition and test applies to all small businesses, including all socioeconomic designations. So before, where we had a different test for small businesses versus 8A versus WSB versus SWSB, the same test is going to apply. So in the final rule, this bullet point list here is what's going to be in each of those regulations. So there still can be negative control if a minority shareholder has the ability to prevent quorum or otherwise block an action, but will not find negative control in those 6 things that SBA has listed originally in the proposed rule, but then has also added kind of this catch-all. Any other extraordinary action that's crafted to protect the investment of the shareholder and does not impede on the majority's ability to control the operations or conduct business. So what does that mean? So you have to look to case law for guidance on what this could include or could not include. Neither of these are exhaustive, but case law, SBA's Office of Hearings and Appeals current case law suggests that certain items that could be permissible as unanimous consent or supermajority include things like amending the governing documents, entering into any substantially different business, committing any act that could result in a change in the amount or character of contribution to capital, increasing or decreasing the size of the board, or mortgaging or encumbering all or substantially all of the company's assets. Those are things that don't occur every day or not, ordinary business functions. In contrast, what types of things are considered, essential to daily operations? These include things like budget, hiring and firing officers, setting compensation, borrowing money, payment of dividends, purchasing equipment. These are all things that if your governing documents provided for unanimous consent or veto rights or supermajority rights, then the agreement would be deemed non-compliant and you could be found affiliated with the minority owner or company that has those veto rights. So that can substantially impact your size as well as your ability to qualify for any of these socioeconomic programs. So why should I care? You should definitely check your governing documents to see if there's if you have a concern that you will not qualify or continue to qualify as a small business or whatever socioeconomic program that you are participating in. This revision to the regulations definitely provides a much clearer picture of what is and what is not permissible across the board. And it's good that we now have kind of a comprehensive, it applies, across the board. It's not going to be different depending on the socioeconomic status. But for joint ventures, the question kind of still is, SBA analyzes affiliation and issues as joint ventures a little bit differently than small businesses. So this should not necessarily have an impact on how JVs are formed and what their governing documents say, but that's something that you would want to take a look at as well. These changes should also make it easier for companies to get minority investors if you're looking for it. An investor may not want to, put up capital or take ownership in a business that they literally have no say over. This will still not give them a say over the daily ordinary business functions, but can give a say over, long-term operations, extraordinary functions to protect their investment. So if you are a small business owner, it may make it easier for you to try to obtain that equity investment. Minority owners may, on the flip side, push for more veto rights, but ultimately, the parties are going to have to agree on what they're comfortable with. Okay, the next change I'm going to discuss is calculation of receipts. This isn't as big of a change in the final rule as it was necessarily in the proposed rule, but it's still worth mentioning. So under SBA's regulations, they calculate receipts using the tax returns that were filed with the IRS. So in the proposed rule, SBA proposed to add language saying that SBA could also consider other relevant information where it appears that the tax return does not properly capture a concern's total revenue. So although SBA did not come out and say this exactly, this was largely intended to apply to IT VARs or value-added resellers. There's an accounting, and I'm definitely not an accountant, but I understand that there's an ability to kind of claim certain revenues depending on if it was passed through or not. In that, SBA had proposed to kind of like trick the IT VARs into this amount, and would kind of give SBA limitless discretion on what they would look at if they had a reason to believe that the tax returns didn't properly capture the revenue. In the final rule, so SBA did receive a number of 7 comments on this particular change, 5 in opposition. So one commenter noted that financial statements may not reflect the revenue the same way it's reported for taxes, and believed it would be unfair to include revenue identified on financial statements that were legally excluded on tax returns. And to maybe someone's surprise or not, SBA agreed. So the final rule clarifies that they will consider a firm's tax returns in every case, and if a concern can legally exclude certain revenue for tax purposes, then SBA will go with that and won't include the revenue either. But they did still kind of include a little bit of a catch-all that if they believe the tax filings are false, then they can look at other information. I'm going to quickly just kind of run through the next couple of things so we can get to the size and status recertification, since I know we're running a little bit short on time. So on the ostensible subcontractor side of things, the most notable thing here is that SBA had proposed that a joint venture could be ineligible if the managing joint venture partner would be unusually reliant on its partner, or if the partner venture is performing primary and vital requirements. Many commenters opposed this, and SBA did not adopt this language in the final rule. So generally speaking, the ostensible subcontractor rule is largely still the same as it exists today, in that a prime contractor cannot be unusually reliant on a subcontractor, and the prime should still perform the primary and vital requirements of the contract. So there were some kind of significant proposed changes, but these were not adopted in the final rule. A few mentor-protégé JV type changes. As we understand from SBA, there's going to be a much more substantive and significant mentor-protégé and joint venture rule change coming at some point in the future. But a couple of changes that are in this particular rule is that SBA has clarified only for-profit companies can be mentors. And then SBA has proposed and adopted where if a company that's a mentor is acquired by another company that is already a mentor and contract holder as a joint venture on the same vehicle, then the mentor has to exit one of the joint venture relationships. So the JV or the protege could then seek to acquire the interest in the contract and potentially have the contract novated, or replace the mentor with another business in the JV to try to continue to qualify as small. So it is an interesting change because SBA doesn't want the same mentor to be on the same vehicle with multiple proteges, but this is kind of a situation that is outside the protege's control. So we'll just kind of have to see how this plays out. Quickly on what past performance or experience an agency can require of the protege partner, because we get this question quite a bit. The current regulations provide that an agency cannot require the protege to meet the same evaluation responsibility criteria, but that it's not really clear what that means. So SBA was trying to clarify. So essentially, they can require some experience, but it has to be at a dollar value, or fewer contracts or lower dollar value. SBA has also clarified, and this is probably a welcome clarification, that an agency can rely solely on the past performance and experience of the mentor if it wants to. So agencies just have to document that decision, that it acknowledges, the protege doesn't have any and it's going with just the mentor. Okay, so with the last few minutes and few slides, I'm going to talk about the recertification impacts, so size and status. The proposed rule significantly altered size and socioeconomic status recertification obligations, and has proposed to make them consistent across the program. So right now there's a different regulation for each different type of set aside, what the impact is and what you have to do if you undergo a quote like triggering event. Generally speaking, SBA's regulations provide that size and status are determined at the time of initial offer, including price, and that the company maintains its size and status for the life of the contract, including any orders issued thereunder. There are certain triggering events that could change this. That could include when a contract is novated, when a small business undergoes a merger, sale, or acquisition, or on a long-term contract prior to the end of the 5th year. The current rule explains that if a contractor undergoes a triggering event and recertifies as other than small, the procuring agency simply cannot take small business or socioeconomic credit. However, the tribunals and courts have found that despite the recertification as other than small, the company can still remain eligible for pending and future set-aside orders, even if they're no longer small. So it merely impacts the agency's ability to take credit, but that doesn't necessarily mean that the company is not eligible for a set-aside order, even if it's no longer small. In the proposed rule, Um, SBA has essentially kind of undone that whole concept, um, but is making a distinction between single award, versus multiple award. So it's important to understand that a lot of these proposed changes and what's going to be and what is in the final rule applies largely to multiple award contract vehicles. Um, so bigger GWACs like Oasis, Stars, Soup, Alliance, whatever acronym you want to use. These impacts, these changes will largely impact those vehicles, but there should not really be an impact to single award contracts. As proposed, SBA was basically proposing ineligibility for any event that results in a inability to recertify. So you wouldn't be eligible to submit an offer on any set aside or reserved order. Couldn't do it within 180 days. No, not eligible for options. If the CO requested recertification, ineligible. So basically proposed across the board ineligibility. So in the final rule, SBA has kind of made some adjustments and has listened to some of the comments. So the final rule still does the consolidation across all small business programs. So there's going to be a new 13 CFR 125.12. So that is going to kind of be the new rule and guidepost for recertification of size and status. So companies are required to recertify size and small business program status within 30 days of a merger, acquisition, or sale, no more than 120 days prior to the end of the 5th year of the contract or any option exercised thereafter, and when requested to do so by the contracting officer, if specifically requested to do so in the task order. So you need to first understand when you're going through any of these acquisitions, whether it results in a qualifying or a disqualifying recertification. So qualifying recertification means, you're still small, still maintain the small business program status. In that case, you're considered to retain that status for up to 5 years, and you remain eligible for set aside or reserved awards because you're still small, you still qualify for the small business program, no impact. A disqualifying recertification, however, is where the company would result in being other than small. And that's what I'm going to talk about for the next couple of slides. Okay, so if you have a disqualifying recertification, what is the impact of that on pending set-aside proposals? So if you have made a disqualifying recertification based on a merger, acquisition, or sale, which occurs within 180 days after the date of offer but prior to award, then you're ineligible to receive the contract. This isn't really a change from the current rule. If the event occurs 180 days after the date of offer but prior to award, then the company would be eligible to receive a pending single award or reserve, which is the same as it is now. But for a multiple award contract, the company would be ineligible for that pending award. So that is a change from the current rule. Like I said, this rule largely impacts multiple award. So if you have a single award IDIQ and you're bidding on future task orders, even if you make a disqualifying recertification at the contract level, you should still be eligible for set aside orders. It's just that the agency can no longer take credit towards its size or status goals. Okay, so kind of the biggest one, what impact does this have on multiple award set aside contracts or multiple award max? If the company makes a disqualifying recertification, then it is ineligible for set aside or reserved orders. If the company that has acquired you involves another small business concern under the NACE code that's assigned to the MAC, then the contract holder is still eligible for set aside orders. It's just, but the agency can no longer take credit. So there's going to be a big distinction between if you're being acquired by a large company or a small company. SBA is really encouraging small to small transactions as opposed to large to small transactions. So there's going to be a difference depending on if the acquisition involves a small business or a large business. If the acquisition involves a small business, then there should not be an impact to your ability to pursue set aside orders and options, but it's just that the agency can no longer take credit. However, if you've undergone a transaction and acquired by a large business, then you are ineligible to bid on set aside orders or receive options under the contract vehicle. So for this particular rule, though, SBA has recognized and heard that this is going to have a significant impact on M&A and companies like strategic plans and when they're looking to sell and to who. So SBA has agreed to put into place a delayed effective date for this particular rule. So if deals occur before January 17th, 2026, and you're large, you've undergone a disqualifying recertification with a large business, the company will still remain eligible to bid on set aside and reserve orders after the deal, but the agency cannot count orders towards its size or status goals. So I fully expect there to be, an uptick and push to get deals closed before January 17th, 2026. Because that is really when the acquisition by a large business will have a major impact to the ability to keep performing or keep pursuing orders and options under a multiple award contract. Lastly, just want to note, so currently there's not a mechanism to allow a protest or size determination if a company believes another company on the vehicle is not small and any certification that they made is incorrect. So SBA has provided a new ability to file a size protest if a company has undergone a recertification, or can also request a formal size determination. So this will definitely, more protests or requests for size determinations if companies undergoing acquisitions, are no longer small. SBA does not want them to continue to be able to bid on orders or options. So they are revising the regulations to allow other companies that hold the vehicle to either file a protest or request a formal size determination. And I know we're just a couple minutes over, but thank you for your time. Let me see, looks like there was one question on, okay, so the ability for the small versus large. So the question is, does the distinction still apply if the combined business becomes large? So yes, it does, because so if the two companies are small and collectively are small, then it's not a disqualifying recertification, it's a qualifying recertification because the company is still small. However, if they're large, then that would be the disqualifying recertification. So that's why it is important. If collectively they're large, you need to look at the size, before the transaction to determine whether or not that whether it's a qualifying or disqualifying recertification. Okay, I think that is all the time we have. If there were any questions that you didn't get to ask or I didn't get to, feel free to reach out to me via email. Thank you again for your time. Apologies for the slight technology hiccup, but thank you again, and have a great rest of your day.